A significant diplomatic and trade negotiation is currently underway in Paris, France, involving senior United States Treasury officials, United States trade representatives, and a Chinese delegation that includes the country's vice premier. Curious. The discussions are taking place over the weekend, during a period when major Western financial exchanges remain closed. The COMEX, the New York Mercantile Exchange, and electronic futures boards concluded their weekly trading session on Friday, with silver registering a closing price of $83.68 per ounce. The Paris meeting is being characterized not as a routine diplomatic engagement, but as a substantive negotiation covering a broad range of interconnected economic and strategic issues. According to the report, the agenda encompasses trade policy, energy security, sovereign debt dynamics, semiconductor supply chains, rare earth element access, and physical commodity markets with particular focus on industrial silver. The report describes the discussions as potentially consequential for global commodity pricing structures over the coming decades. The report provides specific context for the negotiating positions of both delegations. On the Chinese side, the delegation entered the talks carrying what the report describes as a $214 billion quarterly trade surplus, representing net exports over a 90-day period. On the United States side, the report outlines several factors it characterizes as significant constraints on the American negotiating position, including an energy supply situation, an active military conflict in the Middle East involving the deaths of 4 American service members, and the condition of domestic infrastructure and financial markets. Among the specific developments cited in the report is an authorization issued by the United States Treasury Department approving the emergency purchase of 19 million barrels of crude oil from Russia. The report notes this authorization was issued days before the Paris summit commenced, and that it follows a period during which the United States government publicly maintained sanctions against Russia and characterized Russian actions in Ukraine in strong terms. The stated reason for the purchase, according to the report, is concern over heating oil prices in the northeastern United States, approaching $5 per gallon. As the Paris negotiations continue through the weekend, the report draws direct connections between the outcome of these discussions and the trajectory of global silver markets, commodity supply chains, and the broader international financial system. The full scope of those connections and the detailed data points supporting them will be examined closely as this report continues. To fully understand the significance of the Paris negotiations, the report outlines in considerable detail the specific conditions that define the current United States negotiating position. The analysis begins with the energy sector. The report states that the United States, a country that had been publicly advancing a narrative of domestic energy independence through expanded oil and gas production in recent years, has arrived at a point where it was required to seek an emergency crude oil purchase from Russia, a nation it had formally sanctioned and publicly criticized at the highest levels of government. The report attributes this situation to a series of compounding infrastructure vulnerabilities that have developed over several years. Specifically, the report references the 2021 Colonial Pipeline disruption as an event that exposed the fragility of the United States fuel distribution network. It also cites the 2021 Texas power grid failure as evidence of systemic infrastructure weakness. Beyond those events, the report identifies reduced refinery capacity resulting from labor shortages, regulatory constraints, and sustained underinvestment as further contributors to the current energy supply situation. Additionally, the report states that the United States Strategic Petroleum Reserve was drawn down to 30-year low levels during 2022 and 2023, a decision it attributes to an effort to manage gasoline prices ahead of midterm elections. The report further notes that domestic diesel inventories have fallen below a 25-day supply threshold, characterizing diesel as a critical input for the entire American logistics network covering road transport, rail, and cargo shipping. The report then transitions to the military dimension of the United States position entering the Paris talks. It states that 4 American service members have been killed in an escalating Middle East conflict. It describes United States Central Command as unable to fully contain Houthi rebel activity in Yemen, unable to stop ongoing attacks on commercial shipping in the Red Sea, and unable to prevent strikes by Iranian-backed militias against United States military installations in Syria and Iraq. The report states that the Pentagon is managing simultaneous deployments across multiple theaters, including Ukraine, the Taiwan Strait, and the Middle East, and that military equipment is being drawn from long-term storage facilities to meet operational demands. The report then introduces a critical connection between the military situation and the semiconductor supply chain. It states that every category of advanced United States military equipment, including drone systems, missile defense platforms, and communications satellites, depends on semiconductors. It further states that silver is a key material input in semiconductor manufacturing, used in solder applications, electrical contacts, and thermal interface materials. The report identifies Taiwan Semiconductor Manufacturing Company, referred to as TSMC, as the dominant global producer of advanced chips, and notes that TSMC's facilities are located approximately 110 miles from the Chinese mainland. It states that China has been conducting military exercises around Taiwan for a period of 2 years, and that the United States currently lacks domestic semiconductor fabrication capacity equivalent to TSMC. It characterizes Intel as approximately 5 years behind in production capability and identifies Samsung, located in South Korea, as situated in another geopolitically sensitive region. With the United States negotiating position established in detail, the report shifts its focus to China's economic standing and the strategic framework it describes as guiding the Chinese delegation's objectives in Paris. The report states that China's $214 billion trade surplus represents a single quarter of economic activity, covering a 90-day period. It notes that historically, surplus dollars accumulated through Chinese export activity were commonly recycled into United States Treasury securities, a pattern that reinforced the dollar-based international financial system. However, the report states that this pattern has changed. According to the report, China had been redirecting surplus capital away from long-term United States debt instruments and toward the accumulation of physical commodities including gold, silver, copper, and rare earth elements. The report states that the People's Bank of China has purchased gold every single month for 24 consecutive months, adding over 500 metric tons to its reserves since 2022. It attributes this sustained accumulation to what it describes as a strategic assessment by Chinese policymakers regarding the long-term trajectory of the United States dollar and the Federal Reserve's ability to manage inflation without triggering a destabilizing rise in Treasury yields. The report states that Chinese Treasury holdings have been in decline since 2021, with hundreds of billions of dollars in bonds sold and the resulting capital reinvested into physical assets. Within this context, the report describes the specific commodity focus that it says Chinese negotiators brought to the Paris summit. It identifies silver as the primary strategic target, describing it as the single most consequential industrial metal in the current period due to its irreplaceable role in solar energy infrastructure, artificial intelligence server systems, electric vehicle technology, military radar systems, and 5th-generation wireless antenna arrays. The report states that global silver mine output currently stands at approximately 850 million ounces per year, while projected industrial demand is expected to exceed 1.2 billion ounces annually by 2028. That trajectory, according to the report, would produce an annual supply deficit of 350 million ounces, requiring drawdown of above-ground stockpiles to meet demand. The report then addresses the structure of the COMEX silver futures market in considerable detail. It states that registered silver inventory on the COMEX, defined as silver physically available for delivery against futures contracts, fell below 30 million ounces in February 2026. It contrasts this figure against the total open interest in silver futures contracts, which it states stands at over 170,000 contracts, each representing 5,000 ounces of silver. Calculated against total open interest, the report states that this produces 850 million ounces of paper claims against 30 million ounces of registered physical inventory, representing a leverage ratio of 28 paper claims for every single physical ounce held in a registered COMEX vault. The report argues that this structural imbalance creates significant vulnerability in the event that a large-scale sovereign entity begins demanding physical delivery against outstanding futures contracts rather than settling in cash. It states that Chinese state-owned enterprises have been purchasing silver not through futures markets, but through direct acquisition of mining operations, smelting facilities, and refining infrastructure, primarily through joint ventures and long-term supply contracts with mining companies operating in South America and Africa. It describes these contracts as locking in delivery schedules covering 20-year periods at fixed prices, characterizing this approach as fundamentally different from participation in the paper futures market. The report further situates these commodity accumulation activities within a broader monetary strategy it describes as a deliberate Chinese effort to construct a parallel international financial architecture that reduces dependence on the United States dollar and the SWIFT payment system. It states that China has established bilateral currency swap arrangements with Russia, Brazil, Saudi Arabia, the United Arab Emirates, and Indonesia, enabling direct trade settlement in yuan without conversion through dollars. It references the Belt and Road Initiative as a mechanism through which China has secured infrastructure influence across approximately 60 countries spanning Asia, Africa, and Europe. The report also cites the yuan-denominated oil futures contract launched on the Shanghai International Energy Exchange in 2018, describing it as now the third most actively traded oil contract globally, and noting that it is settled in physical gold through the Shanghai Gold Exchange. As the Paris negotiations continue through the weekend, the report turns its attention to the expected sequence of events following the conclusion of the summit and the anticipated impact on commodity markets when Asian trading resumes. The report states that the Paris summit is scheduled to run through Sunday evening Central European time. It describes the expected post-summit sequence as follows. The Chinese delegation is anticipated to return to Beijing late Sunday night or early Monday morning local time, at which point a briefing with Chinese central bank officials and Shanghai Gold Exchange leadership is expected to take place. The report states that the results of the negotiation, including the specific terms and concessions discussed, would be communicated to Chinese financial institutions through this briefing process. The report identifies the Shanghai Gold Exchange reopening on Sunday night Eastern Time as the first significant market event following the conclusion of the Paris discussions. It states that if Chinese negotiators secured physical commodity supply commitments during the summit, the initial market signal is expected to appear in the form of large-scale physical silver purchasing activity on the Shanghai Gold Exchange. The report specifies that this purchasing activity would take the form of physical kilobar delivery orders placed by Chinese state-owned enterprises, as distinct from paper futures contract activity. It argues that this type of physical buying pressure, if it materializes at the scale described, would create a price dislocation between the physical silver market in Shanghai and the paper futures market on the COMEX. The report then outlines two potential responses it attributes to COMEX bullion banks in the event of significant physical delivery pressure. The first is that bullion banks cover their short positions by repurchasing contracts at prevailing market prices, which the report states would drive silver prices significantly higher. The second is that bullion banks declare inability to deliver physical metal against outstanding contracts, a development the report characterizes as an admission of systemic failure in the COMEX pricing mechanism. The report states that either outcome would render the current COMEX closing price of $83.68 per ounce effectively irrelevant as a reference point for physical silver valuation. The report then broadens its scope to address what it describes as the larger strategic context of the Paris summit within a multi-year Chinese economic policy framework. It states that the BRICS nations comprising Brazil, Russia, India, China, and South Africa are engaged in active discussions regarding the development of a commodity-backed currency intended to function as an alternative to the United States dollar in international trade settlement. It notes that Saudi Arabia has begun accepting yuan as payment for oil sales to China, representing a departure from the petrodollar framework that has governed oil trade since a bilateral agreement established in 1974. The report frames these developments as components of a broader structural shift in international finance away from dollar-denominated reserve assets and toward physical commodity-backed trade systems. On the question of industrial silver demand, the report provides additional figures supporting its assessment of the supply deficit trajectory. It states that global solar installation capacity is projected to triple by 2030. It states that artificial intelligence data center construction is projected to require a 400% increase in semiconductor production by 2028. It identifies silver as an irreplaceable material input in high-efficiency photovoltaic solar cells, artificial intelligence server thermal management systems, and 5th-generation wireless antenna arrays, stating that no currently available substitute material exists for these specific applications. The report argues that sustained industrial demand at projected levels, combined with the supply constraints it has outlined, would ultimately require a price discovery process in the physical silver market that is independent of the current COMEX futures pricing mechanism. The report does not provide a specific timeline for the developments it describes, but states that the decisions and commitments made during the Paris summit this weekend represent a consequential moment in the trajectory of global commodity markets, international financial architecture, and the relative economic positioning of the United States and China. It emphasizes that the COMEX silver price registered at the close of trading on Friday reflects the state of a market that was not active during the period in which these negotiations are taking place, and that the physical market conditions being shaped by the Paris discussions will ultimately determine the price at which silver trades when Western markets reopen. That concludes our full coverage of this developing financial and geopolitical story. The Paris summit remains ongoing, and developments from the Asian market open on Sunday night will be closely monitored as further information becomes available. We will continue to bring you updates as this situation progresses. For now, this has been your financial and geopolitical briefing. Stay informed, stay verified, and we will see you in the next report.